Leave a comment down below. Let me know if you believe the S&P 500 can reach 32 to 3,300. Arguably the most accurate person on Wall Street, Mr. Mike Wilson, still believes the stock market could fall an additional 22%.
This is one of the areas, I would say consumer goods in particular, and tech were the two areas of most egregious over-earning and margins as well as top line. And that just has to get wrung out. The thing that concerns me about tech companies, John, is that they're not good cost cutters traditionally, right? They're growth companies. They tend to want to invest into these downturns. They want to invest. Yeah, I mean, unfortunately, I think we're just seeing the last gasp, as you mentioned. I mean, part of that is holiday spend. Okay, so it's the American way. We don't want to be Scrooge. People are going to spend money on the holidays, and I think they're going to probably hunker down. We've heard some large consumer retailers talk about that dynamic where they expect demand to fall off sharply.
Now, for most of 2022, Mike Wilson was definitely a bear, but strategically going bullish at times, and boy, he nailed the bottom of the market, rallied up 18%, and is now becoming bearish once again. Now, I agree 100% with Mike Wilson here, and he's one of the few guys that I actually follow consistently. My thesis is very much in line with what he is saying. I personally think we can get down to about 3,200, and I definitely have concerns if we break 3,000, as I think that would cause a lot of panic selling, which of course would be a phenomenal buying opportunity. If you saw my last video, I did say, however, I think we're going to rally to about 4,100. Reason being is everybody's expecting recession and everybody's expecting a possible next leg down. When we take a look at the fear and greed meter, there's not enough fear and there's not enough greed in the market, and there's a lot of money on the sidelines. So I tend to believe that we are going to see a pretty significant move in the S&P 500 and push a little bit above 4,100, which gets people excited, gets them greedy, and that's where I tend to want to go the opposite direction. People are just looking at inflation and concerned about the Fed, but the real problem is going to be earnings. Now, over the last 13 years, we've had extremely easy monetary policy, stimulus through the roof, interest rates at near zero, and things change when interest rates rise. Anytime you hear inflation kicking up and interest rates on the rise, this is a clear-cut sign of an end of a cycle, which means you want to stay away from high multiples and unprofitable growth. And a lot of YouTubers were actually dumping tons of money at this time frame, which allowed me to realize they don't know enough about investing. Now, Peter Lynch says, don't be an economist, but when you have a Fed coming out and telling you exactly what they're going to do, and you don't use that information the right way, well, it's pretty stupid. So let's talk about a PE ratio here, because this is where I think a lot of new investors are going to get caught off sides. So the S&P 500 is trading for over a 21 PE ratio, and I'm not going to beat a dead horse here, but the average PE ratio in the S&P 500 is usually between 15 and 16. We've had an elevated PE ratio on the S&P 500 due to the fact that interest rates were at near zero and there was no other place to put money, so naturally it's going to inflate the ratio of one of the few places where we can put our money, basically making the trade crowded. So what is the big deal, you're probably asking yourself? A lot of experts believe that earnings right now are very overvalued for 2023, and they haven't come down enough. We're hearing everything from $190 for S&P earnings all the way up to $230. And so while the market can rally in the short term, when we look at the fundamentals of the overall market, it's starting to get expensive as the market rallies into what earnings a lot lower than the market's anticipating. That the S&P 500 should be trading between a 16 to 18 PE ratio when we factor in that interest rates are now on the rise, and there are other places to put money now. Along with that, higher interest rates are going to slow down the economy, which means corporate earnings are eventually going to come down as well, and companies' bottom lines are going to be affected. They also can't borrow for 0% interest rate and deploy that money to earn some sort of return and once again impact corporate earnings. Now, Mike Wilson believes earnings are going to come in between 180 and 190. You put a 16.5 multiple on that, and that's how he arrives at 3,000. Now, I tend to believe that people are still going to spend, whether that's put on credit cards, but they will find a way to spend. And so I believe earnings are going to come in between 200 to 210. And if you put a 16 multiplier on that, you get 3,360. That's where I think we can fall in between that 3,200 to 3,400 mark on the S&P 500. Now, what I want people to understand is that this is a normal multiple for the S&P 500, And so I'm not equating for a possible recession. If we go in recession, earnings are going to deteriorate even more and multiples contract even more. And that's how we get below 3,000. So as this recent rally is definitely impressive, if you believe earnings are going to be impacted here, well, the more this market goes up, the more likely it has a way to come back down. As we all know, markets don't just shoot straight up and shoot straight down. It goes down in ebbs and flows. It tricks people. It makes people concerned. It gives them FOMO. And that's how we get these market reactions. But true fundamentals are telling me that there's probably a little bit more pain ahead. And I tend to lean with Mike Wilson on about a 20% decline from recent levels. This is just my opinion. As always, ladies and gentlemen, appreciate your time and thank you so much for spending it with me. We will see you in the next one. Peace.